Alright, so today we're going to really look at how cryptocurrency mining went down for me, looking at exactly how everything looked physically and where we grew and where we started from. So I'm going to get into this pretty quickly. So the whole deal with mining is basically we're looking at a project that I think went over about the course of a year. And it was a really interesting project because the profitability at the beginning was just huge, and then as time went on it just got worse and worse. So it was a really interesting market where you started to see phenomenal opportunities, and those were really the opportunities that started to fade away as Bitcoin started falling down, and specifically just interest in the market backed away as overall players went away, new money started flowing out, and just the overall crash of cryptocurrencies in 2017. So we're going to go over just like how this physically came together first, and then I'm going to talk about some of the logistics behind it. So up here is probably the most important part, and everything's cleared out now, which is a shame, but you've just got these blue things which are called risers. Doesn't really matter. Essentially what happens is you have the important part down here. This is like the motherboard, where this is what's really connecting everything together, and these risers have these nice little connectors, and they swivel up into these, and you can have full-size graphics cards, right? So those graphics cards again were really just like big little computers. They were like yay big, and they would fit into the computer like here. So you'd have a card, it'd be like this, and I'll probably put up a picture of what the computer looked like with all the graphics cards in it, and obviously they're gone now just because of how the profitability went with it. Went out and sold those. So that's the thing with a project like this, is you have a very illiquid asset in the sense that you can't sell quickly, but it still retains its value, kind of like a piece of property where you can take it and you can definitely liquidate it to a point. It's just not as liquid as like a stock per se. Definitely an investment though, because the computer hardware retains its value, and in a lot of cases, as I talk about in that video on how I lost 100 grand, it really kind of appreciated in value, certain parts of it, right? So like maybe in the motherboard, when maybe these are just the power supplies, all the cables coming out of it, so that's really what powered the computer. And with that, essentially you needed a lot of power, because obviously you've got like 8 graphics cards. Those are going to take a lot of power from the wall. So that was another really big part of this that I didn't initially see coming into it, was actually taking care of all the wiring behind this. So especially at the beginning, there's a lot of power supplies just thrown around, because I had like GPU stacked up power supplies everywhere, because it really was just a tremendous amount of power. Because when I went into it, what I did was I picked graphics cards that were just the most profitable ones to use based on current metrics, but I didn't really look at power consumption. So that was a really big mistake I made, was going into it and buying the graphics cards, which are really the parts that make money, right? So the rest of the computer, like the fans, the power supplies, and the motherboards that we see throughout here, right? Like these are really just to connect everything. They don't actually impact the amount of money you make. What matters, again, are those graphics cards. So, excuse me. Those are the parts that make money, as we talked about in the last video. So when I was setting this stuff up, I really went for the graphics cards that made the most money, but I didn't really look at power efficiency. So that was a little bit, I don't know, I wasn't 100% in on it. So what I would do really initially was looking specifically at the cards that would make the most money. Really turned out to be sort of the most inefficient cards. So I was starting to look at, say, like older cards, so maybe stuff from 2 years ago, 3 years ago, 4 years ago, When in reality, the best places to be looking were like the most innovative, the newest ones from the newest graphics card manufacturers like AMD, Nvidia, etc. Right? So the point was I was looking sort of more for like the best bargain, the best bang for my buck, when I really should have been looking at what fundamentally made the most sense, right? If you're trying to build a really fast computer, does it make sense to buy the older hardware because on paper it looks better? And for me, right, it turned out that it was just dumb, right? So options in the marketplace at the time were somewhere around the bouts of buying something called the GTX 1070. That's a card by Nvidia, and that was a very efficient card at the time, especially with Ethereum the way it was. It just made sense to invest heavily in architectures that did a good job of mining that algorithm. So in essence, you got to a point where the computers running that card were basically the staple benchmark. And what I was trying to do was make more money than just the staple benchmark. So that card at the time was making like $2 to $4 a day, right? So if you have 8 of those, you know, you're making like $16 a day to $40, something like that. When the times were really upscale and mining profits were high. So the point with that was you're looking to get your initial investment back and then build your next rig, scale it up, and compound your growth, which just takes time in a growing marketplace, which is a very interesting time frame. So what I did was I took a diversified portfolio, and as you guys saw in those pictures, all the cards didn't look the same, right? I would have 2 480s, 2 7990s, 2 8990s, which are the same 7990s, and yeah, 295X2, 295X2s. Those are all AMD cards, and AMD cards are, you know, known for being tougher to work with, but at the same time, they offer on paper better results, right? So something I didn't think about at the time was, what is the time value of the work I need to put in to make these more complex architectures work to get the paper gains of better performance? So what do I mean by paper gains and better performance? So like the 295X2, you know, that was a card that was making, I think, like $8 to $12 a day. And it cost, you know, maybe like the same price as, I think, a stock 1080 at the time, something like that. And then the 1080s, they were making probably about 75% of that. So you had better paper performance and you had better monetary value coming out of the mining cards. So obviously, you know, they're all different, right? Because they're different just for diversification's sake. If you guys read chapter 35 of the book, or I think that's what it is, the diversification chapter, we talk about how different streams could go up and down, right? So with some of the graphics cards, you would have a card that would make a lot of money sometimes. Maybe the algorithm goes down, it doesn't make as much money next time. Similarly, you would have cards that just are on a different scale. They mine different currencies maybe, or maybe they're more efficient at certain algorithms, and you can have those that perform better sometimes and maybe not all the time. So with the diversified group of these graphics cards, you can have overall long-term growth, while at the same time having consistent and high current growth. So instead of maybe everything being like one same, you know, like a GTX 1070, there were 4 basically of one, 2 of another, and 2 of another. So it was diversified in the sense that they were all mining sometimes different currencies, sometimes the same currencies, but on different efficiencies and at different levels. So the problem really with it was that these were all older cards and they weren't getting the power efficiency necessary, right? So with the GTX 1070, which was really the staple at the time, you would see stuff moving and the 1070 would only use like maybe 40, 50, 60, somewhere, you know, the low dollar range of dollars per day in electricity, given a consumer electricity rate around 10 cents per kilowatt hour. So as I paid, you know, $1,000 electricity bills, well, not even that point. So the point, right, was those were using, a much smaller portion of their mining potential for electricity. So they were more efficient, obviously, because they were newer. And because they were more efficient, they were more stable in the long term, because you could have lower marketplace profits, but you could still be profitable because you're not paying as much electricity. So it really is just the cost of maintaining it, which is pretty low since you just set it there and it stays clean, you just let it mine. So with the cards I had, we had much higher electric costs, up to half or even more of the profits at the time were getting eaten up by electricity costs. So it might cost like $4 a day to run a card that makes like $6 to $8, something like that. So much higher electric costs, and you multiply it by 8, right? Since it's an 8-card rig, you're just really kind of getting on the margins there. But the thing was, at the time, the market was supporting that. So the market was hot, everything was going up a lot, and you had very high initial gains. So because of that, you're able to support kind of like a worse investment strategy in the short term, even though it looked better on paper with higher potential profits, higher diversification, something that I wasn't looking at, and that you got to holistically consider, are electricity costs and sustainability. We'll get into sustainability in just a second, and then we'll talk about why it's that machine behind me isn't on right now making money. We'll get to that in just a second. But the point with it is to look holistically at your investing style and to really consider what are all the factors in play here. So I think that covers the basic fundamentals and some of the overarching lessons I learned. In the next video, I really want to get into the technicals, not really with like exactly everything I did, but the process I went through to really get this thing to a reality. Like I said, it took me about 4 to 6 months. It was like 5 months. So like, it was a lot of work, physically building it, right? I built computers before. I built computers for clients. I built computers for friends. I'm great, building computers. I love it. It's really fun. Building the thing took like maybe a week and a half, 2 weeks with school and everything. Not a big deal. The tough part was really the software engineering side of it, and actually getting the blockchain and mining algorithms to work on the system, so that you had the machine going and making money. So it was past the investment. Now you're looking at like investment management, which is a totally different part of what I would usually do, because usually you just buy a stock or you buy a cryptocurrency. That's that. With this, you really needed to be committed to it, because you've really got to work, especially with some of these harder cards I picked, right? These were not the easiest cards to work with because I wanted higher profits, which meant that for me, it was a lot more work on my end to get the algorithms working for it. So we'll talk about that in the next video. Look forward to that. And then we'll talk about the overall strategy with it. And of course, why it's not on today, which is just sad. But lessons to learn from it. I look forward to seeing you guys then. Thank you. Have a good one.